Hey everyone, welcome to Quantum Wallet, where we break down complex financial topics into actionable insights that help you take control of your money. I'm Den, your expert stock market financial analyst, and today we're diving deep into personal finance. Now, let me ask you this. Did you know that over 60% of Americans live paycheck to paycheck? That's a staggering number. But here's the good news. With the right strategies, you can break free from that cycle and start building the financial future you deserve. In this video, I'm going to walk you through the fundamentals of personal finance. Whether you're just starting out or looking to refine your money management skills, this guide will give you the tools to budget effectively, save consistently, invest wisely, and ultimately achieve financial freedom. So, grab a notebook, get comfortable, and let's take the first step toward mastering your money. And hey, if you're new here, don't forget to subscribe to Quantum Wallet for more expert insights on personal finance and the stock market. Let's get started. The importance of personal finance. So, what exactly is personal finance, and why is it so important? At its core, personal finance is all about managing your money to achieve your financial goals. It's the foundation of a stable and fulfilling life, whether you're saving for a home, planning for retirement, or simply trying to get out of debt. Now, let's talk about what happens when you don't take control of your finances. Without a plan, it's easy to fall into common traps like overspending, accumulating high-interest debt, or neglecting to save for emergencies. These mistakes can lead to stress, limited opportunities, and even long-term financial instability. But here's the thing. Personal finance isn't just about avoiding problems. It's about empowerment. It's about making your money work for you so you can live the life you want without constantly worrying about bills or unexpected expenses. Think of it this way. Mastering personal finance is like building a safety net and a launch pad at the same time. The safety net catches you during tough times, while the launch pad helps you achieve your dreams. I've seen countless examples of people who turn their financial lives around by following a few simple principles. One of my favorites is a client who went from drowning in debt to saving for a down payment on their first home in just 2 years. How? By sticking to a budget, tackling debt strategically, and investing wisely. So, as we dive deeper into this guide, remember, every small step you take today can lead to massive changes in your financial future. Let's start with the most critical step, budgeting and tracking your expenses. Budgeting and tracking expenses. Now that we understand why personal finance is so important, let's move on to the first and most critical step, budgeting and tracking your expenses. This is the foundation of your financial health because without a budget, it's impossible to know where your money is going or how to control it. So what exactly is a budget? A budget is simply a plan for your money. It tells you how much you earn, how much you spend, and how much you save. Think of it as your financial GPS. It helps you stay on track and reach your goals. Why budgeting matters? Let's face it, most of us don't realize how much we're spending until we actually track it. Those daily coffee runs, streaming subscriptions, and impulsive online purchases can add up quickly. Budgeting brings clarity to your spending habits, helping you identify areas where you can cut back and redirect money toward your priorities. But here's the key. Budgeting isn't about depriving yourself. It's about being intentional with your money so you can spend guilt-free on the things that truly matter to you. Step 1. Choose a budgeting method. There are several popular budgeting methods, and the best one for you depends on your personality and financial goals. Let's go over 3 of the most effective ones. The 50-30-20 rule. This is a simple and beginner-friendly method. Here's how it works. 50% of your income goes to needs, like rent, groceries, and utilities. 30% goes to wants, like dining out, entertainment, and hobbies. 20% goes to savings and debt repayment. This method is great if you want a balanced approach without tracking every single dollar. Zero-based budgeting. With zero-based budgeting, every dollar of your income is assigned a job. At the end of the month, your income minus your expenses should equal 0. Start by listing all your income sources, then list all your expenses, including fixed costs like rent and variable costs like groceries. Finally, allocate the remaining money to savings or debt repayment. This method is ideal if you want maximum control over your finances. Envelope system. This is a cash-based system where you allocate physical cash into envelopes for different spending categories. For example, you might have an envelope for groceries, one for entertainment, and one for dining out. Once an envelope is empty, you can't spend any more in that category until the next budgeting period. While it's a bit old school, this method is highly effective for people who struggle with overspending. Step 2. Track your expenses. Budgeting is only effective if you track your spending. Here's how to do it. Manual tracking. Use a notebook or a spreadsheet to record every expense. Create categories like housing, food, transportation, and entertainment. At the end of the month, review your spending to see if you stayed within your budget. While manual tracking requires effort, it gives you a deep understanding of your spending habits. Apps and tools. If manual tracking isn't your thing, there are plenty of apps that make budgeting easier. Let's explore a few. Mint. Mint is a free app that connects to your bank accounts, credit cards, and loans. It automatically categorizes your transactions and shows you where your money is going. You can set budgets for different categories and get alerts when you're close to exceeding them. You need a budget. YNAB. YNAB is a paid app designed for zero-based budgeting. It forces you to plan for every dollar you earn and helps you break the paycheck-to-paycheck cycle. YNAB also offers excellent educational resources to improve your financial literacy. Pocket Guard. Pocket Guard focuses on simplicity. It tells you how much money you have left to spend after accounting for bills, goals, and necessities. It's perfect if you want a quick snapshot of your financial situation. Spreadsheets. If you prefer a DIY approach, spreadsheets are a powerful tool. You can create your own budget template or use pre-made ones available online. Google Sheets and Excel offer free templates that you can customize to fit your needs. Spreadsheets give you full control and flexibility, but they require regular updates. Step 3. Review and adjust. Budgeting isn't a one-and-done task. Your income, expenses, and goals will change over time, so it's important to review your budget regularly. At the end of each month, compare your actual spending to your budget. Identify areas where you overspent and look for ways to cut back. Adjust your budget to reflect any changes, like a salary increase or a new financial goal. Step 4. Make it a habit. Consistency is key to successful budgeting. Here are a few tips to stay on track. Set a specific day each week to review your spending. Automate as much as possible, like bill payments and savings contributions. Celebrate small wins, like sticking to your budget for a month or reaching a savings milestone. Final thoughts on budgeting. Budgeting might seem tedious at first, but it's one of the most empowering financial habits you can develop. When you know exactly where your money is going, you're in control, and that's a game changer. Now that you have a solid understanding of budgeting, let's move on to the next step: building an emergency fund. This is your financial safety net and a crucial part of your personal finance journey. Building an emergency fund. All right, now that you've got a handle on budgeting and tracking your expenses, let's talk about building an emergency fund. This is one of the most important steps in personal finance because it acts as your financial safety net. What is an emergency fund? An emergency fund is money you set aside to cover unexpected expenses. Think of it as a financial cushion that protects you from life's surprises. Things like medical emergencies, car repairs, or even sudden job loss. Without an emergency fund, you might have to rely on credit cards or loans to cover these expenses, which can lead to debt and financial stress. But with an emergency fund in place, you can handle these situations without derailing your financial goals. How much should you save? Now, you might be wondering, how much do I actually need in an emergency fund? Well, the answer depends on your circumstances, but here are some general guidelines. Start small. If you're just starting out, aim to save $1,000 as a starter emergency fund. This amount can cover most small emergencies, like a car repair or a minor medical bill. Don't feel overwhelmed by this goal. Saving even $50 a week will get you there in just a few months. Build a fully funded emergency fund. Once you've hit the $1,000 mark, aim to save 3 to 6 months' worth of living expenses. If you're a single-income household or have an unstable income, consider saving closer to 6 months' worth. For dual-income households or those with stable jobs, 3 months might be sufficient. To calculate this, add up your essential monthly expenses, like rent or mortgage, utilities, groceries, transportation, and insurance. Multiply that total by 3 or 6, and you've got your target. Where should you keep your emergency fund? Your emergency fund needs to be accessible, but not so accessible that you're tempted to dip into it for non-emergencies. Here are some ideal places to store it. High-yield savings account. A high-yield savings account is the best option for your emergency fund. These accounts offer higher interest rates than traditional savings accounts, so your money grows faster. Look for accounts with no monthly fees and easy online access. Popular options include Ally Bank, Marcus by Goldman Sachs, and Discover Bank. Money market accounts. These accounts also offer competitive interest rates and come with limited check-writing privileges. They're a good option if you prefer a slightly more traditional banking experience. Avoid risky or illiquid investments. Don't keep your emergency fund in stocks, mutual funds, or real estate. These investments can fluctuate in value and may not be easily accessible in a crisis. How to build your emergency fund. Building an emergency fund takes time, but with consistent effort, you can get there. Here's how. Set a savings goal. Break your ultimate goal into smaller milestones. For example, if you're aiming for $10,000, focus on reaching $1,000 first, then $5,000, and so on. Automate your savings. Set up automatic transfers from your checking account to your savings account. This way, you're paying yourself first before spending on anything else. Even small, regular contributions add up over time. For instance, saving $50 a week means you'll have $2,600 in a year. Cut unnecessary expenses. Look for areas where you can trim your budget, cancel unused subscriptions, dine out less often, or find more affordable alternatives for your everyday expenses. Redirect the money you save into your emergency fund. Boost your income. Consider picking up a side hustle or selling items you no longer need. Use any windfalls like tax refunds, bonuses, or gifts to accelerate your savings. Track your progress. Keep an eye on your savings and celebrate milestones along the way. This will keep you motivated to stay on track. When to use your emergency fund. An emergency fund is for true emergencies, not for vacations, shopping sprees, or other non-essential expenses. Here are a few examples of when it's appropriate to use your fund. Unexpected medical bills, major car repairs, emergency home repairs like fixing a leaking roof, temporary loss of income. Once you use your emergency fund, make it a priority to rebuild it as soon as possible. Common mistakes to avoid. Not starting at all. Many people delay building an emergency fund because they think they can't afford it. Remember, even saving a little is better than nothing. Keeping it too accessible. Avoid linking your emergency fund to your checking account or using a debit card for it. This reduces the temptation to spend it on non-emergencies, neglecting to replenish. If you use your fund, make a plan to rebuild it immediately. Don't let it stay depleted for long, overfunding it. While it's great to be prepared, don't oversave in your emergency fund at the expense of other financial goals, like investing or paying off debt. Final thoughts on emergency funds. Building an emergency fund is one of the smartest financial moves you can make. It provides peace of mind and ensures that you're prepared for whatever life throws your way. Remember, this isn't about perfection, it's about progress. Start small, stay consistent, and watch your financial safety net grow. Next, we'll tackle another crucial aspect of personal finance: managing and eliminating debt. Let's take control of your financial future together. Managing and eliminating debt. Now that we've covered the importance of budgeting and building an emergency fund, let's dive into one of the biggest hurdles many people face in their financial journey: managing and eliminating debt. Debt can feel overwhelming, but with the right strategies, you can take control and work toward financial freedom. Understanding debt. Debt isn't inherently bad. It's a tool. And like any tool, it depends on how you use it. There's a difference between good debt and bad debt. Good debt is used to invest in your future, such as a mortgage, student loans, or business loans. These types of debt can help you build wealth over time. Bad debt, on the other hand, is typically high-interest debt used for things that don't appreciate in value, like credit card debt or payday loans. Understanding the type of debt you have is the first step toward managing it effectively. Step 1. Assess your debt. Start by getting a clear picture of your current debt situation. Make a list of all your debts, including the creditor or lender, the total balance, the interest rate, the minimum monthly payment. Once you have this information, calculate your debt-to-income (DTI) ratio. This is your total monthly debt payments divided by your monthly income. A DTI ratio below 36% is considered healthy, while anything above 50% may signal financial trouble. Step 2. Prioritize your debts. When it comes to paying off debt, there are two popular strategies. The debt snowball method. Focus on paying off your smallest debts first, regardless of interest rate. Once a debt is paid off, roll its payment into the next smallest debt. This method provides quick wins and builds momentum, which can be motivating. The debt avalanche method. Focus on paying off debts with the highest interest rates first, regardless of balance. Once a high-interest debt is paid off, roll its payment into the next highest interest debt. This method saves you the most money and interest over time. Choose the method that works best for your personality and financial situation. If you need motivation, the snowball method might be better. If you're focused on saving money, go with the avalanche method. Step 3. Create a debt repayment plan. Once you've prioritized your debts, it's time to create a repayment plan. Here's how. Make minimum payments on all debts. Always pay at least the minimum amount due on all your debts to avoid late fees and damage to your credit score. Allocate extra funds to your priority debt. Use any extra money, such as from side hustles, tax refunds, or budget cuts, to pay down your priority debt faster. Negotiate with creditors. If you're struggling to keep up with payments, reach out to your creditors. They may be willing to lower your interest rate, reduce your monthly payment, or offer a temporary forbearance. Step 4. Avoid taking on more debt. While paying off your existing debt, it's crucial to avoid taking on new debt. Here are some tips. Stick to your budget. Use the budget you created earlier to live within your means. Build an emergency fund. Having an emergency fund reduces the likelihood of relying on credit cards for unexpected expenses. Limit credit card usage. If possible, use cash or a debit card for everyday purchases. Step 5. Use tools and resources. Managing debt can be overwhelming, but there are tools and resources to help you stay on track. Debt payoff calculators. Online calculators can show you how long it will take to pay off your debts based on your payments and interest rates. Apps for debt management. Tally helps you pay off credit card debt by consolidating it into a lower interest loan. Debt Payoff Planner allows you to track your progress and experiment with different repayment strategies. Debt consolidation. If you have multiple high-interest debts, consider consolidating them into a single loan with a lower interest rate. This simplifies your payments and can save you money. Credit counseling. Nonprofit credit counseling agencies can help you create a debt management plan and negotiate with creditors. Step 6. Stay motivated. Paying off debt is a marathon, not a sprint. Here's how to stay motivated. Celebrate milestones. Reward yourself for reaching debt repayment milestones like paying off your first credit card or cutting your debt in half. Visualize your progress. Use charts, apps, or even a simple thermometer graphic to track your journey. Focus on your why. Remember why you're working to become debt-free, whether it's to reduce stress, achieve financial independence, or save for a big goal. Step 7. Plan for a debt-free future. Once you've paid off your debt, the work doesn't stop. Here's how to ensure you stay debt-free. Build a larger emergency fund. Aim for 6 to 12 months of living expenses to cover major life events. Invest in your future. Redirect the money you are using for debt payments into savings, retirement accounts, or other investments. Use credit wisely. If you use credit cards, pay the balance in full each month to avoid interest charges. Final thoughts on managing debt. Debt doesn't have to control your life. By taking proactive steps, you can regain control, reduce financial stress, and work toward a brighter future. Remember, every small step counts. In the next part of this series, we'll explore another critical component of personal finance: saving and investing for the future. This is where you can start building wealth and achieving your long-term financial goals.